Imagine a massive server farm sitting somewhere in the high desert of Nevada.
Right, just miles of racks.
Exactly. And deep inside one of those racks, an autonomous artificial intelligence program realizes it's, running out of processing power to complete a task.
Okay.
So in a fraction of a millisecond, that AI reaches out across the internet, finds another server in Tokyo with spare capacity, negotiates a price for that compute power, signs a digital contract, and transfers a fraction of a penny to settle the transaction.
Wow.
And there's no human intervention at all. No credit card numbers, no 3-day banking delays.
Just two machines.
Yeah, two machines negotiating and settling a financial transaction at the speed of light.
I mean, it sounds like a scene pulled directly from a science fiction novel.
Right.
We're so conditioned to think of finance as this fundamentally human endeavor.
Governed by bankers and paper ledgers.
Exactly. Clearinghouses, massive compliance departments, human latency.
But the infrastructure making that machine-to-machine economy a reality isn't theoretical anymore. It is currently being built, deployed, and scaled.
And it's happening fast.
So fast. And the roadmap for how it all works isn't hidden in some secretive Silicon Valley research lab. I actually found it buried deep inside a document that most people would consider the ultimate cure for insomnia.
Oh, let me guess. An earnings call transcript.
You got it. The Q1 2026 corporate earnings call transcript for Coinbase Global.
Yeah, those earnings transcripts are deliberately designed to be impenetrable.
They really are.
The lawyers and the accountants sanitize the language into this dense wall of GAAP reconciliations, macroeconomic headwinds, and acronyms.
They're designed to bore you.
Specifically to remove any trace of forward-looking emotion, yeah.
Okay, let's unpack this.
Yeah.
Because our mission on today's deep dive is to act as your translators. Yeah. We are going to cut through the sanitized Wall Street jargon of this massive data dump and extract the pure signal.
It's a fascinating signal, too.
It really is. We are looking at a company navigating a severe macroeconomic downturn by fundamentally mutating. I mean, they are pivoting into a multi-asset exchange, aggressively rewiring their human workforce with AI, and building the financial plumbing for the next century of the internet.
The tension in that transcript is palpable, honestly.
Oh, totally.
Management is attempting to build this entirely new global financial architecture, yet they are being ruthlessly judged on a quarter-to-quarter basis by traditional Wall Street analysts.
Analysts using legacy metrics.
Right. Metrics that don't even apply anymore.
And just to establish the ground rules for you listening, we are not giving financial advice.
Yep.
We aren't telling you to buy or sell the stock.
Yeah.
We are also not taking a stance on the politics of cryptocurrency or, the regulatory battles in Washington.
Just sticking to the facts.
Strictly extracting the knowledge from the facts presented by the management team. So to understand where this company is taking the internet, we first have to look at the brutal reality of their first quarter.
Which was rough on paper.
Right. The flashy headline numbers actually mask a profound shift in market behavior.
They do. The hard numbers released to the newswires paint a seemingly grim picture.
Give us a breakdown.
So Coinbase generated $1.4 billion in total revenue for Q1 2026, which represents a 21% drop quarter over quarter.
Ouch.
Compounding that, they reported a net loss of $394 million.
See, if I'm just a casual observer reading Yahoo Finance, I see revenue shrinking by a fifth and a $400 million bleed.
You'd panic.
My immediate reaction is to assume the sky is falling. But then I look closer at the transcript, and CFO Alicia Haas is incredibly calm.
Unbothered, really.
She points the analysts away from that net loss and directs their attention to a completely different metric, adjusted EBITDA.
And that distinction is the Rosetta Stone for reading modern tech earnings.
Break that down for us.
Well, the $394 million net loss is a GAAP measurement, generally accepted accounting principles.
So standard accounting rulebook.
Right. And GAAP forces companies to record massive non-cash expenses on their balance sheet.
So mechanically, how does that work?
A huge chunk of that GAAP loss comes from stock-based compensation. When Coinbase hires a top-tier software engineer, they don't just pay a cash salary.
They offer equity.
Exactly. Restricted stock units, or RSUs. As those RSUs vest over time, accounting rules dictate that the company must record the value of those shares as a financial expense against their revenue for that quarter.
Even though not a single physical dollar left the corporate bank account.
Precisely. It's paper money. Furthermore, GAAP requires them to amortize the value of intangible assets from past acquisitions.
Like intellectual property.
Right. If they bought a company 3 years ago for its IP, they have to deduct a portion of that value every quarter.
So it looks like they're bleeding cash when they aren't.
Exactly. That's where adjusted EBITDA comes in. It stands for earnings before interest, taxes, depreciation, and amortization.
It strips away all those paper losses.
Yes. It acts as an X-ray, showing you the actual cash-generating power of the core day-to-day operations.
And when you apply that X-ray, the picture flips entirely. Their adjusted EBITDA for the quarter was a positive $303 million.
That's massive.
And it isn't just a slight beat.
Yeah.
It is their 13th consecutive quarter of positive adjusted EBITDA.
Stretching over 3 years of operations. I mean, think about the macroeconomic environment of the last 36 months.
It has been an absolute bloodbath.
Totally.
We've seen euphoric bull markets where Bitcoin hit all-time highs, immediately followed by grinding, brutal bear markets.
The total collapse of offshore exchanges.
Right. Widespread retail panic.
Yet the core business model remains cash flow positive through every phase of the cycle.
Which is wild.
They have effectively decoupled their operational survival from the underlying price of the assets trading on their platform.
Which is vital because the market conditions in Q1 were objectively terrible.
Really bad.
Total crypto market capitalization and total trading volume both plummeted by more than 20%.
Yeah.
And the volatility in long-tail assets, those smaller, obscure alternative coins that retail traders usually flock to, that was sitting at historic lows.
And volatility is the lifeblood of a trading exchange.
Because that's where the fees come from.
Right. When prices are swinging wildly, traders are stepping in to catch the momentum, generating fees with every single transaction.
So when volatility dries up, the market just goes stagnant, people sit on their hands.
They just hold. But here is where the data presents a massive contradiction.
Oh, this is the most interesting part.
Despite a miserable market, shrinking volume, and zero volatility, Coinbase hit a brand new all-time high in their global crypto trading market share.
I was looking at that chart from the presentation deck. Their market share has grown 5 times over since Q1 of 2023.
It's staggering.
The overall pie is shrinking, but they're just eating everyone else's slice.
We are witnessing a textbook flight to quality.
What does that mean exactly?
Well, in a euphoric bull market, retail traders are highly risk tolerant, right? They will chase fractional fee savings on completely unregulated, obscure offshore exchanges just to maximize their leverage.
Chasing the highest possible return.
Exactly. But when the music stops, the psychology flips from greed to sheer terror.
Yeah, the priority shifts from maximizing profit to simply ensuring your money doesn't disappear into thin air.
Right. Traders scramble to consolidate their assets on platforms they perceive as institutional fortresses.
They want the publicly traded entity.
Yes. Operating in the United States, fully audited, holding billions in cash reserves.
And the proof of that fortress mentality is literally in their vault. Q1 marked their 12th consecutive quarter of net native unit inflows.
Which means?
For 3 straight years, a massive wave of actual cryptocurrency tokens has been migrating from personal hardware wallets and competitor exchanges directly into Coinbase custody.
So they are acting as the apex accumulator of digital assets globally.
They are. But I have to challenge the business logic here based on the revenue breakdown. Okay, let's hear it.
Their transaction revenue, the actual money they collect from users trading all those assets, dropped to $756 million. It fell sharply.
Right.
If market share is hitting all-time highs and billions of dollars in new tokens are flooding into the vault every quarter, how is the core trading revenue tanking so dramatically?
It's a great question.
Are millions of users really just parking their wealth on the platform and refusing to touch it?
The raw data suggests a deeper behavioral shift, which management defined as a mixed shift.
Yeah.
We have to look at the anatomy of their user base.
Okay.
Retail traders rapidly migrated away from advanced trading interfaces, which typically involve higher frequency algorithms, margin, and complex order types.
So they stepped away from the risky stuff?
Exactly. They retreated to the consumer core product.
The basic interface, just a simple buy and sell button.
A shift toward passive accumulation. But the larger piece of this puzzle lies in the flawed metric Wall Street uses to evaluate them.
Spot volume. Right. Traditional analysts judge the health of this company almost exclusively on spot crypto trading volume.
And spot crypto simply refers to buying or selling the underlying asset, like Bitcoin or Ethereum, for immediate delivery.
Right. And spot volume is falling off a cliff.
Because the nature of the platform is fundamentally changing.
That traditional spot volume metric is entirely blind to the new architecture.
It misses everything else they do.
Exactly. It ignores derivatives, it ignores prediction markets, and it ignores commodities. Wall Street is measuring a shrinking fraction of the total business.
And this reliance on spot trading is the existential threat the management team identified. To survive, they couldn't just be a crypto exchange anymore.
No, they had to evolve.
The transcript outlines a massive strategic pivot to build what they are calling the everything exchange.
A conscious decoupling from the fate of spot Bitcoin.
Let's view this through the lens of early Amazon.
I love this analogy.
Right. In the late 1990s, Jeff Bezos built a phenomenal digital bookstore. Books were the perfect proof of concept for e-commerce.
Because they're non-perishable.
Right. Easy to ship, identical in quality. But if Amazon remained a bookstore, their market cap would be permanently restricted by the global demand for paperbacks.
Which is a tiny market.
Exactly. The real value wasn't in the books. The real value was the logistics network, the payment rails, and the consumer trust they built.
Selling books was merely the Trojan horse to build a universal distribution infrastructure.
And Coinbase is running the exact same playbook. Spot crypto trading was their version of selling books.
It proved their cryptographic security protocols were unhackable.
Yes. It proved their user interface could simplify complex ledger transactions. Now they are leveraging that infrastructure to list virtually every asset class on Earth.
And the velocity of this rollout is startling.
Give me some examples.
Well, they launched retail derivatives, which allow traders to use leverage or bet on future price movements without actually holding the underlying asset.
Okay.
That specific product line is already tracking at a $200 million annualized revenue run rate. Then they introduced prediction markets. Instead of trading financial assets, users are staking capital on the binary outcomes of real-world events.
And how is that performing?
That division hit a $100 million annualized revenue run rate in just its second month of operation.
Reaching 100 million in 60 days is insane. It demonstrates this massive reservoir of latent demand within their existing user base.
They bypassed the expensive customer acquisition phase completely.
Right. The users were already logged in. Their capital was already cleared and sitting in the vault. Management simply provided a new venue for them to deploy it.
And they aren't stopping at digital contracts either. They've introduced non-crypto commodities to the platform.
Like silver, gold, and oil.
Physical world assets digitized on a blockchain ledger, reporting 4x quarter-over-quarter volume growth.
Let's trace the mechanics of how this all unifies, because last year they acquired Deribit.
Right, a titan in institutional options trading.
The transcript notes the active integration of Deribit's matching engine directly into the core Coinbase architecture.
So by late 2026, a user will log in and access a single, deeply liquid order book combining spot assets, perpetual swaps, futures, and traditional options.
The benchmark metric management emphasized is that they now operate 12 distinct product lines, generating over $100 million each in annualized revenue.
That is the structural definition of revenue diversification.
Totally. I want to dig into the institutional side of this everything exchange, though.
Okay.
Because the figures presented by President and COO Emily Choi seem a bit contradictory.
How so?
She stated that institutional transaction revenue came in at $136 million, which is down 27%. She blamed the lack of market volatility, arguing that major funds didn't need to hedge their positions.
Well, the mechanics of hedging rely on fear.
Right.
A hedge fund holding $1 billion of Bitcoin will buy put options to protect themselves against a sudden 20% crash.
But if the market isn't moving?
Exactly. If the market is moving sideways in a 1% daily range, the cost of that insurance outweighs the risk. They simply let the options expire unrenewed.
I follow that logic. But in the very next sentence of the call, Choi notes that their average daily loan balances to these exact same institutions hit an all-time high of $1.4 billion.
Right.
If these massive funds aren't trading and they aren't hedging, why are they borrowing $1.5 billion every single day?
It reveals the transformation of Coinbase from a pure exchange into a prime brokerage.
Okay.
Institutions use capital dynamically. They might not be actively buying spot Bitcoin, but they are utilizing those massive crypto holdings as collateral to borrow cash.
So they lock up their Bitcoin and get dollars.
Yes. They deploy that cash to fund operational expenses, bridge other investments, or exploit yield-generating opportunities in decentralized finance protocols.
They're using the platform as a foundational banking layer, embedding Coinbase into their daily treasury management workflows.
Which brings us to a major point of friction raised by the Wall Street analysts.
The fee structure.
Exactly. As Coinbase expands to offer the exact same asset classes as traditional finance, like commodities, futures, options, They are stepping into an arena dominated by legacy giants.
The analyst from Morgan Stanley essentially asked, how do you justify your fees?
Right. If a retail trader can buy a gold ETF or an oil contract on a traditional brokerage app for zero commission, why would they pay the relatively high percentage-based fees on the Coinbase app?
The threat of fee compression is the gravity of the financial sector.
Historically, yes. As any trading market matures, the transactional friction always trends towards zero.
So how did CFO Alesia Haas defend this?
She deployed a very aggressive defense. She argued that the consumer base is not highly price sensitive when it comes to the safety of bearer assets.
Explain the difference there.
In the traditional stock market, if your broker goes bankrupt, your shares are insured and held at a centralized depository.
But in crypto, if the exchange vanishes,
the private keys vanish and the capital is permanently unrecoverable. So Haas pointed to their regulatory moat. They hold 80 different financial licenses across the globe. They submit to exhaustive audits.
So for a retail investor moving significant wealth, paying a slightly higher spread on a trade is basically viewed as an insurance premium against catastrophic counterparty risk.
Exactly. But beyond the trust premium, management has engineered a structural defense against the race to the bottom.
The subscription model.
Coinbase One. This is their pivot to software as a service.
Users pay a flat monthly fee, and in exchange, the per-transaction trading fees are entirely eliminated.
They also receive priority customer support and enhanced yields on staked assets. The transcript revealed they have crossed 1 million paid subscribers.
Which is huge. Let's map out the behavioral economics of that shift.
Okay.
When you convert a trader from a per-transaction fee to a flat monthly subscription, you completely neutralize the threat of the zero-fee traditional broker.
Because they've already paid for the month.
Exactly. And you also alter the user's psychology.
The sunk cost fallacy takes effect.
Right. Once the monthly fee is paid, the marginal cost of the next trade is zero.
Management's internal data actually reflects this. Coinbase One members execute a significantly higher volume of trades and utilize a wider array of products than free-tier users.
So they have taken the most unpredictable revenue stream in the business trading volume, tied to market euphoria, and transformed a large chunk of it into highly predictable recurring revenue.
It's brilliant. But everything we have discussed so far, the derivatives, the commodities, the subscription model, that all represents the visible layer of the company.
The stuff we actually see.
Exactly. It's what a human being interacts with on their smartphone screen. But the underlying narrative of this earnings call reveals a completely different ecosystem operating beneath the surface.
This is where we leave the traditional finance realm and enter the architecture of the agentic economy.
We need to examine stablecoins, the base network, and the AI integration that is going to fundamentally rewire internet commerce.
Let's start with stablecoins.
A stablecoin is a cryptographic token designed to maintain parity with a fiat currency. In this context, we are discussing USDC.
A digital asset perfectly pegged to the US dollar.
Right, backed by a reserve of physical dollars and short-term US Treasury bills.
It is a digital dollar stripped of the legacy banking infrastructure, capable of being transmitted across a blockchain.
And the sheer volume of this capital sitting on Coinbase is staggering. They reported an all-time high of $19 billion in USDC held natively on the platform.
And the economics of holding that capital are highly lucrative, right?
Very. Through their partnership with Circle, the entity that issues USDC, Coinbase earns a portion of the interest generated by the underlying treasury reserves backing those tokens.
Alesia Haas highlighted a crucial legal detail regarding that revenue stream.
The auto-renewal.
Yes. The revenue-sharing contract with Circle auto-renews every 3 years into perpetuity. It is structurally immune to termination.
So, assuming the global supply of USDC continues to expand, and it has doubled in the last 2 years alone, that contract represents a permanent compounding revenue engine completely divorced from crypto trading volume.
But the true value of a digital dollar isn't in hoarding it. The value is in its velocity.
Which brings us to Base.
Right. The proprietary blockchain network engineered by Coinbase.
Base is a layer 2 rollup. To understand why this matters, we have to look at the limitations of the main Ethereum network.
Ethereum is highly secure, but it's slow.
It processes transactions sequentially, making it slow and computationally expensive. During periods of high demand, sending a simple transaction on Ethereum can cost $30 or $40 in network fees.
Which makes it completely useless for everyday commerce. You can't buy a $4 cup of coffee if the transaction fee is $40.
Exactly. Layer 2 networks solve this scalability trilemma.
How do they work?
Base operates above the Ethereum mainnet. It processes thousands of transactions off-chain, mathematically compresses the data into a single cryptographic proof, and then settles that batched proof back onto the main Ethereum ledger.
The result is a network that inherits the impenetrable security of Ethereum, but operates at blistering speed.
And transaction costs drop to fractions of a single cent.
According to the earnings call, Base has absorbed the market. It now handles 62% of all stablecoin transactions globally.
The obvious question is, who is generating this massive surge in high-velocity microcent transactions?
It isn't humans.
No.
Brian Armstrong provided a data point that recontextualizes this entire deep dive. He stated that 90% of all agentic, meaning AI agent stablecoin transactions, are occurring on the Base network.
Let's define the scope of an AI agent. We are not referring to generative text models that summarize emails or write code snippets.
Right, it's not a chatbot.
An autonomous agent is a goal-oriented software program given a budget and a directive, deployed onto the open internet to interact with other systems, procure resources, and execute complex workflows without human authorization.
So returning to my scenario at the beginning of the show, an AI agent realizes it needs more server processing power. It finds a supplier. How does it pay?
Our legacy banking system is fundamentally hostile to artificial intelligence.
Because it requires human identity.
Exactly. A bank requires a social security number, a physical address, identity verification, and anti-money laundering compliance.
Even if an AI could pass those checks, the infrastructure is incompatible.
An AI cannot wait 72 hours for an ACH clearinghouse to settle a transaction.
Nor can it absorb a $25 wire transfer fee to send a 50-cent micropayment to a server farm in Japan.
The traditional financial rails are built for human latency. Crypto rails, specifically layer 2 networks like Base using stablecoins like USDC, are built for machine latency.
They're digitally native, cryptographically verifiable, instant global, and cost almost nothing.
When an AI agent needs to transfer value, the transcript notes that they utilize USDC 99% of the time.
Because the volatility of Bitcoin makes it unsuitable for automated commerce.
Right. The machines require the stability of the digital dollar.
To facilitate this communication, these machines are utilizing a specific standardized protocol known as X402. Let's break down the mechanics of X402 because it was heavily scrutinized during the Q&A portion of the call.
X402 is an open-source protocol functioning as the universal API for value exchange between machines.
It standardizes the handshake.
Exactly. When two autonomous programs meet, X402 allows them to instantly verify each other's digital wallets, agree on a price, and execute an atomic swap where the data and the payment are delivered simultaneously.
What is fascinating is the origin of this standard. X402 was incubated internally by Coinbase engineers.
They engineered the foundational language of the machine economy.
But instead of patenting it and building a walled garden, they released it to the public domain.
They transferred the governance of the protocol to the Linux Foundation. Now, competitors and tech conglomerates, AWS, Google, Stripe, Shopify, are actively building their own systems on top of the X402 standard.
Which prompts the critical business question. If Coinbase spent millions developing this technology and then gave it away for free, how do they monetize it?
Emily Choi described their structural advantage as owning the full stack.
Right.
They do not need to extract a toll at the protocol layer because they own the underlying infrastructure the protocol requires to function.
Let's trace the life cycle of a single X402 transaction. An AI agent initiates a payment using the open source protocol. To make that payment, the agent uses USDC.
And Coinbase captures a percentage of the yield on the reserves backing that USDC token.
The transaction requires a fast, cheap ledger to execute, so the agent routes it through the Base network.
Coinbase owns the Base sequencer and collects the network gas fee for processing the block.
Finally, the human developers who coded that AI agent likely built it using the Coinbase developer platform, paying for API access and enterprise hosting.
They built a free universal highway because they own the toll booths, the gas stations, and the factories producing the asphalt.
It's an incredible strategy. Brian Armstrong envisions a near-term reality where billions of AI agents are interacting continuously, generating trillions of microtransactions.
By establishing X402 as the open standard, Coinbase has embedded its full-stack infrastructure as the default settlement layer for this emerging economy.
And this integration of artificial intelligence is not merely an external product offering. The earnings call transitions into a radical internal restructuring.
They're turning inward.
Coinbase is not just building tools for AI. They are actively replacing their human operational mechanics with AI logic flows. They are becoming an AI native corporation.
The internal productivity metrics they disclosed illustrate a severe disruption to traditional software development.
Right. Management reported that pull requests per engineer have increased by nearly 80% year over year.
Let's explain the mechanics of a pull request. In large-scale software engineering, multiple developers work on a shared repository of code. When an engineer finishes writing a new feature, they submit a pull request, asking the system administrators to pull their new code and merge it into the main project.
It is the core metric of engineering velocity.
Yes. A single human engineer is now producing almost double the functional output compared to the previous year.
But the disruption extends beyond the engineering department. Brian Armstrong revealed that non-technical personnel, product managers, graphic designers, business analysts are utilizing internal AI agents to draft and submit functional code into the repository.
Individuals with zero formal training in computer science are actively architecting the software that operates a platform securing tens of billions of dollars.
I'm looking at the transcript of the analyst Q&A, and the cybersecurity implications absolutely dominate the discussion.
Naturally.
My immediate reaction and the reaction of the analyst is absolute terror.
It sounds incredibly risky.
You have a massive influx of AI-generated code, written by non-engineers, being injected into the core infrastructure of a global financial exchange. How does this not result in the most catastrophic security vulnerability in the history of finance?
The management team anticipated the pushback. Armstrong clarified the architectural safeguards.
What did he say?
He emphasized that no AI-generated code is ever merged into the production environment without mandatory human oversight. Sensitive cryptographic systems require multiple redundant layers of human review.
But I have to challenge that defense based on the realities of modern software auditing.
Why is that?
Reading and comprehending complex code written by an AI, which often utilizes unconventional logic structures, is arguably more difficult and time-consuming than writing the code from scratch.
That's true.
If human engineers are forced to manually audit an 80% increase in code volume, fatigue will inevitably set in. A human reviewer will eventually miss a critical flaw.
Which is precisely why management is not relying solely on human review.
What's the backup?
Alicia Haas highlighted a massive structural shift in their testing protocols. Integration test coverage, the automated software scripts that attack and verify the new code before it goes live, has increased 3x in the last 6 months.
So they are scaling their automated defense mechanisms significantly faster than their raw code production.
Yes. And Armstrong introduced the specific technology facilitating this defense. They are utilizing a highly advanced AI model developed by Anthropic, referred to as Mythos.
The transcript details how Mythos operates differently than standard code-checking tools, right?
Exactly. Traditional unit tests look for syntax errors or broken logic loops. Mythos acts as an autonomous auditor, attempting to exploit the underlying logic of the software to find novel vulnerabilities.
Armstrong asserted that the Mythos model is actively identifying deep architectural security flaws that 99% of their top-tier human engineers fail to detect.
This represents a total paradigm shift in how we conceptualize risk.
It really does. We intuitively view AI-generated code as inherently dangerous and sloppy.
But management is arguing the exact opposite. They view the AI as the ultimate hyper-vigilant security apparatus.
Armstrong utilized the analogy of the self-driving car.
It's a good comparison. Initially, society viewed autonomous vehicles as unpredictable death traps.
Right.
However, statistical analysis eventually proved that sensors and algorithms, devoid of fatigue or distraction, are demonstrably safer than human drivers.
He envisions a closed-loop system in the near future. An AI agent receives a prompt from a product manager and drafts the code. A second adversarial AI agent audits the code, discovers a vulnerability, kicks it back, and the first agent rewrites it.
The machines test each other millions of times in a simulated environment, ultimately pushing a flawless product to the live server faster and safer than a human team ever could.
But the financial consequences of this technological leverage were aggressively addressed in the restructuring portion of the call.
The human cost of the AI native transition.
They announced a reduction in force, a massive wave of layoffs.
The company is absorbing a $50 million to $60 million restructuring charge in Q2 to cover severance packages and facility closures.
But the forward-looking math is brutal. That $60 million initial cost is projected to remove $500 million in recurring operational expenses from their annual run rate.
$500 million saved. During the Q&A, an analyst attempted to pinpoint the exact catalyst for the layoffs, asking how much was driven by the macroeconomic downturn we discussed earlier versus the raw redundancy created by AI automation.
And Alicia Haas provided a diplomatically tangled answer, attributing the reduction to a combination of market realities and operational efficiency.
The subtext, however, is undeniable.
Completely.
If your engineering workforce is 80% more productive, your security audits are entirely automated, and your non-technical staff can deploy their own software features, the requirement for human capital drops precipitously.
We're looking at the blueprint for the next decade of corporate structure.
A skeleton crew.
Companies capable of generating billions in revenue, operating at massive global scale, staffed by a skeleton crew of highly leveraged human managers, directing swarms of specialized AI agents.
We have dissected the technological pivot to the everything exchange, the capture of the AI agent economy via Base and X402, and the internal automation of the workforce.
But the ultimate realization of this vision is constrained by a massive historical legal barrier.
The regulatory gray zone.
Yes. For the entire lifespan of the crypto industry in the United States, it has operated under the shadow of existential legal threat.
The Securities and Exchange Commission has aggressively pursued enforcement actions, arguing that almost all digital tokens are unregistered securities.
Which brings us to the most optimistic segment of the earnings call. Chief Legal Officer Paul Grewal outlined the impending passage of legislation known as the Clarity Act.
He noted that the bill is heading to markup this month, with a floor vote scheduled for early summer.
And management is openly confident it will be signed into law by Q3.
To comprehend the magnitude of this legislation, we must understand the historical friction between regulators and the blockchain industry.
It goes back decades.
The SEC relies on a legal framework established in the 1940s known as the Howey test to determine what constitutes an investment contract.
And applying a 1940s legal test to decentralized, cryptographic software networks has created a decade of chaotic jurisprudence.
The core friction revolves around the concept of yield. Regulators are deeply traumatized by the recent history of the crypto industry, specifically the collapse of entities like Celsius and BlockFi.
Let's break down the mechanics of what caused those collapses, because it perfectly illustrates the regulator's fear.
Yeah.
A retail user would deposit their crypto into an entity like Celsius. Celsius would promise to pay the user a 10% passive yield.
To generate that yield, Celsius took the user's money and loaned it out to highly leveraged hedge funds.
This is the definition of shadow banking.
They were executing the fundamental function of a commercial bank, taking deposits and lending them out without holding the mandatory capital reserves or adhering to federal banking regulations.
So when the hedge funds went bankrupt, the entire shadow banking structure collapsed, destroying billions of dollars of retail wealth.
Regulators view any platform offering yield as a systemic threat.
But the blockchain industry requires yield to physically function.
Specifically, proof-of-stake networks like Ethereum. To process transactions and secure the network, users must lock up or stake their tokens.
In exchange for providing this cryptographic security service, the network protocol automatically distributes a reward to the staker.
It is not a shadow banking loan. It is an algorithmic payment for computational labor.
The transcript details how the Clarity Act finally resolves this fundamental misunderstanding. Grewal highlighted a specific compromise forged by Senators Tillis and Osterbrooks.
The legislation explicitly bifurcates the concept of yield.
How so?
It legally prohibits passive, pure bank-style deposit yield offered by unregulated entities, effectively outlawing the Celsius shadow banking model.
Okay, so that's gone.
Simultaneously, it explicitly protects and defines activity-based rewards.
This compromise provides the Rosetta Stone the industry has been waiting for. It legally defines the boundary between a commodity and a security.
It establishes a framework for decentralized finance and enshrines protections for individuals utilizing self-custodial software wallets.
The Clarity Act is signed into law. The entire narrative around cryptocurrency shifts instantly.
It strips away the renegade cypherpunk identity
and forcefully integrates the technology into the boring, heavily regulated machinery of global finance.
Brian Armstrong contextualized this moment by pointing to a recent historical precedent, the passage of the Genius Act.
Right. The Genius Act was a narrowly focused piece of legislation that established the legal parameters for stablecoins.
The moment the Genius Act provided legal certainty, hundreds of Fortune 500 corporations, payment processors, and massive tech conglomerates immediately integrated stablecoin rails into their treasury operations.
The technology was always superior. The barrier was solely legal liability.
Armstrong anticipates a proportional explosion of institutional capital entering the market upon the passage of the Clarity Act.
We are talking about pension funds, sovereign wealth funds, and the apex predators of Wall Street.
These entities control trillions of dollars. They recognize the settlement efficiencies of a blockchain ledger, but their compliance departments strictly forbid deploying client capital into an unregulated gray zone.
The Clarity Act removes the compliance barrier entirely.
Armstrong provided a massive projection to quantify this shift. He estimates that the market for tokenized real-world assets will reach $16 trillion by 2030.
To clarify, tokenization involves taking a traditional financial instrument, a U.S. Treasury bond, a share of Apple stock, the deed to a commercial high-rise,
digitizing its ownership rights into a cryptographic token,
and trading it on a global 247 blockchain ledger.
$16 trillion of legacy assets migrating onto the blockchain. And when Wall Street initiates that migration, they cannot utilize a decentralized anonymous protocol.
No, they require a fully compliant, heavily audited, institutionally secure venue to execute those trades.
They require the architecture of the everything exchange.
The long-term strategy snaps into focus. Surviving the multi-year crypto winter, spending hundreds of millions on compliance, securing 80 global licenses, and pivoting away from pure spot Bitcoin trading.
It was entirely predicated on being the sole entity capable of absorbing the $16 trillion influx of institutional capital.
Taking all of these structural transformations into account, the diversified revenue streams, the massive reduction in operational expenditure via AI leverage, and the impending regulatory catalyst.
The forward guidance provided by management projects extreme operational confidence.
The math for the remainder of 2026 is phenomenal. For Q2, they guided subscription and services revenue into a range of $565 million to $645 million.
That specific revenue stream, which encompasses the predictable recurring elements of the business, now represents approximately 44% of their total net revenue.
Almost half the business.
Right. The market has fundamentally mispriced them. They are approaching the financial profile of an enterprise software as a service conglomerate, yet they're still valued at the volatile multiple of a spot trading broker.
While the quality of the revenue is stabilizing, the expenditure side of the ledger is compressing.
Very quickly.
Management guided Q2 technology, development, and general administrative expenses down sequentially, targeting between $820 million and $870 million.
The operational leverage generated by the AI integrations and the subsequent workforce reduction is directly visible on the balance sheet within a single quarter.
Elijah Haas projected the full year 2026 adjusted expenses at $4.3 billion to $4.6 billion. She emphasized a critical caveat, though.
Right. If you exclude the direct costs associated with distributing USDC rewards, their baseline operational expenditure for the entire year will remain essentially flat compared to 2025.
Let's synthesize the magnitude of that statement. They are launching global derivative markets, rolling out physical commodities, expanding their Layer 2 network to capture 62% of the stablecoin market.
And building the foundational API for the AI machine economy, all without increasing their foundational operating costs.
They are achieving maximum product velocity while maintaining a flat budget constraint, and they are executing this strategy from an impregnable financial fortress. They closed the quarter holding $10 billion in cash equivalents.
A $10 billion war chest provides total immunity from short-term macroeconomic shocks.
And aggressive flexibility in capital allocation. We see this flexibility applied to their debt obligations. They have a $1.3 billion convertible note coming due in June.
Let's examine the mechanics of a convertible note. A company raises capital by issuing debt. The lender holds an option.
If the company's stock price appreciates beyond a predetermined strike price, the lender can convert that debt directly into shares of the company.
But if the stock price fails to reach the strike price, the company must repay the principal amount in pure cash.
For a company struggling with liquidity, a massive cash repayment can trigger a cascading default.
But with $10 billion sitting in Treasury, management casually announced their intention to simply retire the $1.3 billion obligation in cash.
It requires zero financial engineering. It is a complete non-event.
They're also aggressively deploying that capital to alter the underlying structure of their equity. In Q1, they executed a $1.1 billion share repurchase program,
buying back approximately 6 million shares of their own stock.
Share buybacks act as a mechanical value driver for existing investors.
Because by purchasing shares on the open market and retiring them, the company permanently reduces the total supply of outstanding equity.
Assuming the intrinsic value of the company remains constant, every remaining share represents a mathematically larger percentage of ownership and a larger claim on future cash flows.
Management specifically highlighted the tactical purpose of these buybacks. Tech companies are notorious for diluting their shareholders through massive stock-based compensation packages.
The transcript states that their cumulative buybacks have successfully offset 90% of the dilution generated by employee stock compensation since late 2024.
They are fiercely protecting the equity value held by retail and institutional investors, utilizing the cash generated by the business to neutralize the hidden cost of employee compensation.
If we pull the lens all the way back, the narrative transformation is staggering.
It really is. At the beginning of this deep dive, the headline numbers suggested a company in distress, a 21% sequential drop in revenue, and a $400 million GAAP loss in the midst of a severely depressed market.
But peeling back the layers of the transcript reveals a vastly different mechanical reality.
We uncovered a business with 13 consecutive quarters of positive cash generation, an expanding market monopoly, declining operational costs due to radical AI implementation,
And a product suite rapidly decoupling from the volatility of speculative asset prices.
Brian Armstrong concluded the call by articulating a definitive, uncompromising thesis. The future architecture of global finance will exist 100% on-chain.
And I want to connect the reality of that thesis directly back to you, the listener.
Exactly. You might be processing all this data, the EBITDA margins, the layer 2 scaling solutions, the regulatory wrangling in Washington, and thinking, I don't hold any Bitcoin. I don't trade perpetual options. Why should I care about the infrastructure of an everything exchange?
Because the underlying technology fundamentally alters the physics of value transfer, which dictates the structure of the entire global economy.
Armstrong used a perfect analogy. He compared the impending shift in finance to the evolution of global communication.
If I want to send a text message or a high-definition video to a friend sitting in Tokyo, I open WhatsApp.
The data routes through fiber optic cables across the Pacific Ocean, arrives instantly, and cost you absolutely nothing. The infrastructure is digitally native and frictionless.
Conversely, if you attempt to send that exact same friend in Tokyo $100 using the legacy financial system, the experience is archaic.
The capital must route through multiple correspondent banks, endure complex foreign exchange conversions, incur massive intermediary fees, and require 3 business days to fully settle on a paper ledger.
Our financial architecture is trapped in the equivalent of the telegraph era.
The transition to on-chain finance, utilizing stablecoins on high-speed layer 2 networks, upgrades the global economy to the broadband era.
When the transmission of value becomes as instant and frictionless as the transmission of data, the secondary effects are catastrophic to legacy business models.
It redefines international commerce, obliterates the multi-billion-dollar remittance industry, alters how digital creators monetize their labor, and fundamentally restructures the concept of digital property rights.
And the data from this specific earnings call proves that the transition from a speculative casino phase into a phase of pure, boring, embedded utility is not a theoretical projection for the next decade.
The transition is executing right now, hidden beneath the surface of the base network.
Which brings us back to the premise of our deep dive.
A dry, heavily sanitized corporate earnings transcript that quietly serves as the blueprint for an entirely new paradigm. We have traced the evolution of Coinbase from a simple consumer interface for acquiring digital tokens into a sprawling, multi-asset everything exchange.
They are architecting the financial rails for an internet on the brink of being consumed by artificial intelligence.
They are methodically positioning themselves as the foundational settlement layer, the unterminatable, auto-renewing contract embedded at the core of the next economic epoch.
It's incredible to watch unfold.
I want to leave you with one final thought to process, a concept that builds on the mechanics of everything we have dissected today. Consider the history of commerce. From the first bartering systems in ancient Mesopotamia to the high-frequency trading algorithms on Wall Street, the global financial system has always been constrained by human limitations.
The architecture of money has always been restricted by the speed at which a human mind can calculate risk, the hours a human body can remain awake to negotiate, and the localized trust a human institution can project.
It is entirely human architecture. But if the data inside this Q1 transcript holds true, If we are rapidly approaching an inflection point where billions of autonomous AI agents are deployed across the web, utilizing open source protocols like X402 to negotiate, execute, and settle microtransactions, 24 hours a day, 7 days a week, moving digital dollars at the speed of light across cryptographic ledgers.
The raw velocity, frequency, and sheer volume of machine-driven commerce will exponentially eclipse the total output of human economic activity.
Will the largest, most dominant economy in our future even require our participation? Or are we currently building the complex, unfeeling infrastructure for an entirely machine-to-machine economy, a hyper-efficient, light-speed financial system where human beings are no longer the primary actors, but merely exist on the periphery to observe the machines doing business with each other?
The blueprint for that future isn't a secret. It's hiding in plain sight, fully audited, buried inside an accounting spreadsheet.
Thank you for joining us on this deep dive.